Hi, everyone. This is Jason Burak of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a first-time guest. I've been wanting to speak to him for a while, but he's just so busy right now that finally we could fit him in. He could fit us into his busy schedule. He's joining us from Singapore. His name's Grant Williams. Let me just read his long bio pretty quick. Grant Williams has reached 30 years in finance. Over that period, he has held senior positions at a number of investment banks and brokers, including Robert Fleming, UBS, Bank of America, and Credit Suisse, in locations as diverse as London, Tokyo, New York, Hong Kong, Sydney, and Singapore. Grant is portfolio and strategy advisor to Vulpes Investment Management in Singapore, and is also one of the founders of Real Vision Television, an online on-demand finance channel showcasing the brightest minds in finance. Sounds very interesting. From humble beginnings in 2009, his newsletter, Things That Make You Go, has grown to become one of the most popular and widely read financial publications in the world. A regular speaker at investment conferences across the globe, Grant blends history and humor with keen financial insight to produce unique presentations which have been enthusiastically received by audiences everywhere. So thank you for joining us today, Grant.
Jason, it's a great pleasure. I think we could have shortened that bio down a little bit.
Well, I think it's very impressive. You've accomplished a lot in your career, and you're still doing entrepreneurial things. I think it's awesome.
Well, if you can stick out this finance game for a long time, I think it's just survival of the fittest sometimes.
Yeah, or it's just like go get a bailout for most of these guys. Most of these guys, some of these guys, run their firm into the ground and get a bailout. Anyway, though, let's move to our first interview topic. I want to talk about interest rates here. Most of Wall Street, the conventional Keynesians on Wall Street, they seem convinced that the Fed can raise interest rates, that there's actual an economic recovery in the U.S. Do you think the Fed is trapped, though?
I think they're trapped, and I think they know it. It's fascinating what's happened, and this incredible monetary experiment that we're in the middle of. And it is that. I mean, these guys have no idea what they're doing. They're winning it on a daily basis. But to have interest rates at zero for this length of time, the longer it goes on, the more it compounds the problems of capital misallocation. And I think the plan really was hope. Let's keep interest rates low and hope that organically the economy repairs itself. And by this point in the cycle, 6 years into zero interest rates, they would have hoped to have had more leeway to raise rates. But now they're being forced into the position of having to promise to do that just to really maintain their credibility and their integrity. And I don't think there's any chance in hell they can raise them. I don't think that means they won't, but I think what it means is if they do, they will be forced into lowering them again very, very quickly. And if that happens, their credibility is gone. And this whole thing, not just with the Fed, but with the BOJ, the Bank of England, the ECB, it's a confidence game in the true sense of that term. These guys need the market to have confidence in them. And I think that when we write the history of this particular chapter, the move by the Swiss National Bank last month is going to be seen as a pivotal turning point, because what we saw there was the first admission by a central bank who had promised to do something, quote unquote, in unlimited quantities, back away because those unlimited quantities were getting too big for them. And so that's the first warning shot across the bow that central banks as a group are not omnipotent. They can't do things in unlimited quantities. It all sounds great, and when you look back to July of 2012, when the eurozone was essentially about to splinter apart, Mario Draghi made his famous "whatever it takes" speech, and those three words literally turned the entire thing around because people had confidence that these guys were on top of it and that they really would do whatever it takes. If you fast forward to last year when Tim Geithner's story of the crisis was published, he anecdotally tells a story which actually I'm surprised didn't get an awful lot of mention in the press, but he spoke in one of the chapters about how Draghi had essentially scribbled those words on a napkin before, 5 minutes before he went out and gave that speech. So that's how close to falling apart the European Union was. That's how seat of the pants these guys are playing it. And so far it's worked. But the Swiss National Bank, after promising markets for 2.5 years that, hey, the peg is good, it's a core pillar of our monetary policy, we're going to defend it in unlimited amounts, they took the peg away. Not only did they take the peg away, but they did it without telling the markets deliberately. Thomas Jordan, the Swiss Bank governor, said, when you make moves like this, you have to take the markets by surprise. That should be a warning to everybody that central banks ultimately have a limit to their capabilities, and we are pushing up hard against those limits all around the world.
Yeah, that's why you see rules changes, coming out on a Friday afternoon or late Friday night when markets close, so they kind of, get the weekend to digest. I think that's done intentionally, but I completely agree with your point there at the beginning, what you said, that I think the Fed is trapped too. I think they basically have a math problem coming up in the near future, whereas this debt continues to grow. Obama says, oh, the economy's recovering. Oh, our debt didn't really grow. I mean, the total debt is still growing. Maybe it slowed its growth rate in terms of how much it's growing. But I really don't think they can raise rates meaningfully. I think the Fed is kind of, obviously Bernanke said he didn't want to end up, the United States to end up like Japan, but now we're in the situation here where, they've kind of done a lot of the similar mistakes that Japan has done, where they wouldn't allow, the banks to go bust. They wouldn't write off these bad debts, restructure them or stuff to go bankrupt. And now you have either zombie banks or you just have enormous misallocations of capital, like you said. And if rates go, if the interest rates were to normalize to revert to the mean, whether it's the United States or Japan or Europe, we would have banks that are drastically over-levered, and their debt-to-equity ratios would wipe them out. And then we have sovereign governments who, they can barely afford these debt payments at artificially manipulated interest rates. How are they going to afford the debt payments, when the interest rates normalize?
Well, look, they can't. I mean, you hit the nail on the head right at the beginning there. They have a math problem. And the beauty and the problem with math is that the laws are inviolable. You can't change them. And so having the inordinate amount of debt that you have in a situation economically that you have it in means you cannot pay those debts off. So it doesn't matter what you want to do. And for Bernanke to say, yeah, we don't want to be Japan. Sure, of course you don't want to be Japan. Nobody wants to be Japan. But then you go ahead and follow the playbook almost to the letter. Why? Because it's politically unpalatable to make the decisions necessary to not be Japan. It's painful. If you don't want to be Japan, you have to let the banks go bust. You have to let there be a drastic correction. And that time was 2008, and they stuck Band-Aids on it and have compounded the problem ever since with, I don't think Bernanke in his wildest dreams would have expected to have printed roughly $4 trillion. I don't think when they set out on this that they ever dreamed they'd get here. But of course, once you set out on this path, you have to either follow it to the end or turn around and go home. And if you turn around and go home, all hell's let loose. And the great thing about Keynesian policies is always the fact that when they don't work, and let's face it, they basically never have, the reason they didn't work is that you didn't do enough. You didn't do it hard enough. You didn't press the pedal hard enough to the floor. So you've always got that built-in excuse. And it'll be the same this time. If it doesn't work, at some point in history, someone is going to look back and say, you know what, if only Bernanke printed $8 trillion, it would have all been okay. But of course, it wouldn't, it won't, and it never will be.
Yeah, that's totally a totally ridiculous argument, but you and I both know that they're going to keep on repeating it because the majority of people, Grant, the regular people on Main Street, some of them don't even have enough money to own assets, or stocks or things like that. They don't pay that much attention to markets. Maybe they spend 5 or 10 minutes with the mainstream financial media, or the mainstream news, and they just don't pay as much attention to you and me, or either they don't know or they don't care, and it's just really sad. But you talked about.
Sorry to interrupt you, but this is a really, really important point because you're right. The majority of people aren't invested in the stock market. So having the stock market go higher helps out a very small fraction of people. But what I've been thinking a lot about and what I find fascinating is that everybody, whether they are invested in the stock market or not, in fact, more so those who aren't because they probably don't understand it as well, when something bad happens like 2008, the headlines in the newspapers are always stock market crash, Dow down 500 points, whatever it may be. So the benefit of having the stock market go up that goes beyond increasing the wealth of those, or the wealth effect of those invested in it, because obviously until you actually sell your stocks, you haven't actually made any real money. The benefit of this policy that goes beyond that is that when bad things happen, people instinctively look for a headline about the stock market crashing, even if they're not invested in it. If something in the news happens like Greece, but people don't see the stock market crash, they assume, with their limited knowledge of the moving parts, that it's okay, because if it was really bad, the stock market would have crashed. So that's a very interesting psychological point and a very interesting psychological benefit of getting the stock market up. It's not just about making the people invested in it feel wealthier. It's about the comfort that people who aren't invested in it have from the fact that the stock market didn't crash.
Yeah, that's a great point about the wealth effect. I mean, there's many different reasons to prop up the asset prices. You know, you named one of them. The other one is it keeps the United States government's the capital gains tax base, their annual tax revenues from capital gains. It keeps them pretty normalized, so the government sees it as a return on investment. So you know, if they print X amount of billions of dollars a year, right, but they can keep the asset prices high enough, they get even more of those nominal phony paper gains that are not, you know, real gains. They get more of those each year.
Well, yeah, they do, but at the end of the day, when you can print money, those gains aren't necessarily that important to them. I don't think that's a primary concern of theirs, because they have this machine in the basement of the Mariner Eccles building.
Now, you talked about financial repression without naming it. How much longer do you think that Japan, the United States, Europe, can they keep you know, this kind of game? I call it stagflate and lie, where, you know, basically they're flooding money into asset markets and creating asset price inflation. You know, maybe in Japan's case, the imports for food and energy, those things are going up like crazy. In the United States, there is evidence of inflation in certain things. How much longer do you think they can keep this going before more people start to wake up and notice, you know, what's going on and all the policies that they've been, you know, repeatedly saying that they need to do are not working?
Well, no, that's the $64,000 question. Always, you know, it's never what, it's always when. And I think if you'd asked anybody 3 years ago, 4 years ago, if we'd get to 2015 without this game ending, they would have said no. But we're here. It feels everywhere you look as though the walls are closing in on these guys, and the fact that we do have this very clear currency war now is only going to speed up the end game of this whole process. But realistically, none of us know when this is going to fall over, because it is, as I said, it's a confidence game. And so who knows when confidence snaps? And at some point it will snap. You know, we saw it in Greece with the election of Syriza. They're now walking back on their election promises, so it's going to be very interesting to see a political party that had 81% support for their policies who backtracked on them. It'll be interesting to see what the backlash is. That spreads to Spain with Podemos, who are, you know, another radical party who are leading the polls, and who I suspect, if the quantum of Spain going off the reservation is way more dangerous than Greece, which is partly why they're trying to fix Greece, because they don't want Spain to upset the apple cart. But if the voters backlash against Syriza for backtracking on their pre-election promises to stand up to the EU, that's just going to make the Spanish extreme party far more dangerous, because they'll know that if they get elected on that platform, walking it back is not going to go down well. So all these things, they build on each other, and they build each other, and the pressure ratchets up, and we just don't know when the whistle's going to blow, but it will blow. The trick as an investor is managing to stay in the game until it does, and it's being made purposely very difficult to do that. So a lot of smart people, you know, I'm fortunate enough to travel all around the world and speak to really some of the brightest financial minds on the planet, and an inordinate amount of them are heavily in cash right now, just waiting for an opportunity to invest that, and more to protect it, because they've had some great gains, and right now the risk reward is skewed very heavily against them in terms of, from all-time highs, could this thing squeeze up another 10%? Probably could. but it's definitely a case of up the stairs and down the elevator. So when we do get a meaningful correction, it's not going to be 5%. It could be a very quick 20, 25% on its way to 40 or 50 if things aren't done to stop it. And so the first rule as an investor is to avoid big drawdowns. They're the things that kill you over time. You can't afford to take a 50% hit to your portfolio because you have to make 100% to get back to where you started from, and that's never an easy thing to do. So it's confidence. It could go at any time, and nobody really knows when that will be, but the signs are getting more and more obvious that day is approaching us fairly rapidly.
Yeah, up until 2015 started, Grant, it seemed that, volatility had been abnormally low for the 2 years prior to that in 2013, 2014. And now, we've started to see enormous volatility in currencies. We're starting to see black swans, where the Swiss took off the depegging. I guess the Swiss Central Bank got word that the ECB was going to print ahead of time, and that's why they took off the peg. I guess they just basically said enough. They did a 180. You mentioned that earlier in the interview, and then the oil price crash. So, we had all three of these events within, 6 months of each other, and currencies which normally don't really move that much. Normally, a 2% move in the currency market is considered pretty large for 1 year, but we're getting 10, 15, 20% moves in the currency markets now in a good number of currencies.
Well, that volatility is crucial. When you suppress volatility, my friend Raoul Powell is my partner in Real Vision Television. He calls it Raoul's Law. I think he's stolen it from someone else probably, but I'll let him have it. But he says, suppressed volatility always leads to hypervolatility, and he's right. It's not a coincidence that straight after the Swiss National Bank removed that peg and removed, more importantly, that complete faith in the promises of a central bank, that we started to see this volatility return. And it has been dampened, but it's been dampened not because markets are benign, because they never are, but it's been dampened because of these promises from central banks that they will always have the markets back. And now one of those promises has been broken, and it reintroduces the concept to markets that volatility is possible again should any other central banks make similar moves in changing their policy without giving the market due notice. I mean, when did we get to the point where markets expected to have everything telegraphed to them in advance? That's never been the case, but it is now because it has to be. They're so frightened what markets will do if they believe that the policies instituted and implemented by the central banks don't lead to smoother returns and higher markets and stave off the possibility of a collapse, that the markets are being pandered to by the central banks like never before. And that's incredibly dangerous because, as I said at the beginning of the interview, there is a very definite limit to what these people can do. Don't for a second think that just because they can print unlimited amounts of money, which they can, it gives them unlimited powers, because they can print all the money they want, but as soon as people lose faith in that money, it becomes worthless no matter how much they print. We saw this in Weimar Germany back in the 1920s. And just because it hasn't happened doesn't mean it won't.
Yeah, I completely agree. Now, about Greece leaving the euro, do you think that's a high probability event? And do you think we're going to see other countries leave the euro, like maybe the other PIGS countries? Or do you even think at this stage, maybe behind the scenes, Germany's working on a contingency plan to either split up the euro maybe into the Scandinavian bloc, where there's more prudent countries there, or would Germany potentially have a plan in place to leave the euro in the near future?
Well, no, I think Greece's exit from the euro is inevitable. The fact that it hasn't happened this time, that doesn't mean it's not going to happen. It's completely unsustainable. The issue here is a political one. The reason that the EU are fighting so hard to keep Greece in is that if Greece were to leave, it's not necessarily Greece that's the problem. It's the contagion risk that it presents. And again, we get back to volatility. When uncertain outcomes become possible again, it upsets the entire process. So I think Greece's exit is inevitable. What they've done at this particular point, they've made a whole bunch of promises, which, let's face it, they've made promises every time they've needed money, and they've never actually gone through with them. And they won't this time. they'll make the promises, of course. I mean, look, put yourself in Greece's position. You want 4 billion euros and you want it quick. What are you not going to promise to do? The question is, at what point do the EU finally get sick of the promises and say, you know what, we don't care what you promise us. We know you're not going to hold true to them. No more money for you. That's the point when Greece leaves. But if you're Greece, why would you not want to take the money? Because how do they possibly hold you to those promises? At some point, they will have to. But in the meantime, take all the money you can. So the exit of Greece is inevitable in my mind. And I think it has been for a couple of years now. They've kicked the can down the road. The length of each kick is getting shorter. We're now down to a 4-month can kick. But the Spanish elections aren't until the end of this year, November, December time. So if Greece leaves before the Spanish elections, that could be a problem for Europe. So both sides have a lot to lose here. I think the Greeks are in a much stronger bargaining position than people think. It's a question of whether they have the courage to go through it. Now, I'm not saying it's the best idea for them to do it, because it will cause a lot of problems in the Greek economy and societally. But at some point, Europe is going to get tired of them and say, okay, no more money. Do the strong countries leave through the top? Possibly, but look, we've actually now had a demonstration of what happens when a strong country leaves the euro, because Switzerland had de facto become a member of the euro with the peg, and they are far more Deutschmark in similarity than they are to the drachma. And when the Greek peg ended, the currency shot up 30-40%, which is exactly what you could expect to happen to the Deutschmark. So what Germany can't have is a 40% stronger currency. So the pressures on them, to keep this thing together, even though the liabilities that they've built up under the Target 2 payment system are extraordinary. So this whole thing, is incredibly complex. There are so many moving parts to it, but I think the exit of Greece certainly is inevitable. And should that not be as disastrous as a lot of the fearmongers are saying, you can bet that Spain will exit, as will potentially Italy, and the whole EU project could fall apart.
Yeah, that's very interesting. I know, Grant, after the 2008 crash, when everything was falling apart, I know there were a number of European countries in the EU that had started, printing their own national sovereign currencies again in preparation for leaving the euro, but then, it didn't completely disband. But, I think the whole thing that they put it together, the way they put it together, it wasn't going to work, the euro. But it's managed to stay together for longer than most people think. But, that just because it stayed together longer than most people think doesn't mean it's a good idea.
Right, yeah, look, it was always going to work. The question was, would it work when its first crisis appeared? And the answer was no. But obviously, they all went into this thing with a very optimistic view about how growth would be forever. And look, the political ideals behind the EU are sound. They didn't want. They had a century of war. They didn't want ongoing wars, and so they wanted to bind Europe together, which is an admirable ideal. But of course, it could never work without this fiscal union. And the signs were only going to be evident when they had their first crisis. And hey, lo and behold, along comes a crisis, and guess what? It doesn't work. And that's unfortunate, but nobody could have said it's a surprise.
Yeah, I mean, okay. Well, switching gears to my next topic that I have for you, it seems the United States has declared economic war on Russia and Vladimir Putin. The Russian ruble was down before the oil price started going down. I don't think there was a full fundamental supply-demand justification for how much the oil price fell so quickly. I don't know if you paid attention to my work, but I've interviewed about 6 oil experts at length, asking them about the oil market in the last month or so. And, we've seen bond downgrades of Russian bonds from American bond agencies, who are basically, I think in September, either August 2011 or September 2011, when they were downgrading the U.S. bonds, the U.S. was threatening American rating agencies, with jail and removal of licenses and loss of $1 billion. It just seems, these bond rating things are a very political weapon now. What's your opinion on the U.S.'s economic war with Russia?
Well, everybody needs a bad guy. we always need a bad guy, and Putin is a terrific bad guy. He really does play the part well. What's not reported in the Western press so much is the approval ratings that Putin has in Russia, which are the envy of any Western politician. And so, look, Putin is a very clever man. He has his own agenda, and he works towards that. But unfortunately, the powers at work trying to turn the screws on him are perhaps not all out in the open. And as I said, he presents a very good bad guy figure. Russia is a sleeping giant, no doubt. They do have these tremendous oil and gas reserves, etc. The problem with the economic war against Russia, which is clearly ongoing, is that it has driven them even harder towards the East and China. And that's a real problem because an isolated Russia is something that you can influence. If the result of that isolation drives them into the arms of China and the other BRICS countries, who are way more powerful now than they ever have been in terms of their share of world GDP, their share of currency reserves, they're a very dangerous bloc to bind together. And the unintended consequences of any kind of wish for regime change in Moscow is that you are cementing this BRICS alliance. And there are all kinds of signs. If you just look in the weeds for the trade deals being done to trade directly between all these countries in their own currencies and bypass the dollar. If you look at pipeline construction, if you look at the development of the first BRICS Banc, which is an alternative to the IMF, there are signs everywhere that an entirely new and potentially incredibly strong currency bloc is being built here that will be a real rival to the United States. And on its own, Russia is not a rival to the United States. It just isn't. It doesn't have the power that America has. It doesn't have the reach that America has. But Russia aligned with China and aligned with India and aligned with Brazil and aligned with the Turkeys and Iran and the other Middle Eastern Gulf countries, that's a real threat to American domination of the world. And the Chinese are smart. They play a much longer game than most people. And this pushing of Russia into their arms is, I think, going to backfire very, very badly at some point in the future. And if Putin does go, who's to know who comes next? Because if you're the former head of the KGB, you're a pretty ruthless character. For a guy to come in and depose Putin somehow it would have to be someone who is equally, if not more, ruthless. And that's probably not someone that the West want to face either. So what do you do? It's very dangerous meddling in these things. You never know what the outcome's going to be.
Yeah, I completely agree that about the unintended consequences. It seems, that the U.S. people who don't understand Austrian school economics or free market economics, they don't see that them putting this economic war on Russia with the sanctions, telling the rating agencies to bond grade, attacking their currency, that this is going to accelerate Russia, teaming up with China and setting up the next global financial system where the dollar is as the sole world reserve currency, or the petrodollar, where these old systems could potentially, I don't know about crash, but at least they're going to be drastically weakened in the near future. And Russia and China are both putting the groundwork, the foundation in place. I think Russia's already testing a new SWIFT system, right? An alternative one.
Yeah, no, they've launched it now. It's up and running, and that's been their Achilles heel. The last time sanctions were upon them, that was their Achilles heel, and so they've gone about and they've made contingency plans for them, which is what you do. But people get caught up in the pictures of the fighting from Ukraine and fighting from the Donbass region, and the reporting, which is pretty poor, I have to say. It's certainly not balanced. That's one thing you can promise it isn't, because as I said, there has to be this good guy bad guy narrative. Now, and I'm absolutely not sticking up for Putin's adventures into the Crimea and the Ukraine, but Crimea was a part of Russia for hundreds of years, and you'll notice that was given up quite easily by the West because I think they realized that there was arguably a Russian claim on it. Ukraine is different, and I think any time that you're looking to station lethal weapons on the border of another country, you are antagonizing them. And the fact that that NATO is reaching now as far as Ukraine was never foreseen back in the day when the treaties were signed. What's interesting, I think, is that with the Minsk peace accord, which obviously looks pretty much in tatters now, but when it was signed a couple of weeks ago, what it said was that Russia, Germany, and France would guarantee these borders, and by doing that, what you've essentially done is made it possible that if the US continues this idea of sending lethal weapons into Ukraine to arm the Ukrainians, you're then pitting the US against Germany and France, who've committed to maintain these borders. So Europe is far more, if you think about it, aligned with Asia. There are books been written going back to the 1900s that talk about whoever controls Eurasia controls the world. And it just so happens that for our lifetimes, Europe and Asia have been separate blocks. But the more this goes on, and the more you isolate the biggest country in the center of Europe, the more you tend to weld this Eurasia bloc together. And Eurasia is the biggest block of people on the planet. It's the biggest market on the planet. It's the biggest combined set of resources on the planet. It's a very powerful thing to accidentally build. But by continuing to hammer on Russia and continue to talk about putting lethal weapons into Ukraine, when France and Germany, the two powerhouses of the EU, have guaranteed those borders, again, it's somewhat foolhardy in my view.
It's myopic, I think. I think it's, the people, I live right outside of D.C., Grant, and it seems like, the PhDs in, Russian literature, the guys who've worked in the State Department or the Department of Defense and the Pentagon, the guys who hated the Soviet Union and were kind of, felt like bored and out of work when the Iron Curtain fell, seems, they're back in full force now. They're having fun with this. Too much fun. You know what I'm saying? Where they're like, oh yes, we get to attack Russia again, and we get to do all this bad stuff to Russia. Whereas, they're missing the big picture that, Russia and China are teaming up to destroy the petrodollar and maybe move to like a gold-backed trade settlement or something like that.
Yeah, look, the Chinese. I actually was fortunate enough to sit and talk to Simon Hunt, who's a good friend of mine this week, who's one of the best voices on China and this whole geopolitical confusion that I know. He spent a lot of his time in China. He's a fantastic resource, and he has connections at the very highest level in China. He was saying that the Chinese don't want the world's reserve currency, but they do want the yuan to be a major unit of trade around the world. So what the Eastern Bloc wants and what the US wants are different things, but unfortunately they can't coexist. And so the difficulty in assessing what's going on in China and Russia is the lack of access to balanced reporting that doesn't devolve everything into good guy, bad guy. It's very hard to get that, and you generally have to do it by actually speaking to people who spend time in those places. At Vulpes, we have a Russia fund. We have a lot of contacts in Russia, so we get information from people on the ground about what the mood is and how the sanctions are biting. I talk to people who spend 3 or 4 months a year in China talking to party officials and business owners. You get a much better sense of what's actually happening here than you do if you read the Wall Street Journal or the Daily Telegraph, and that's not to pick on those two, I'm just picking mainstream publications. You get a much better sense of what's going on than the current mainstream journalism, which I just don't think has the resources or the desire to go as deep into these stories and find all the various shades of grey. It's much easier to paint them as black and white, which they're clearly not.
Yeah, I agree. The news cycle is just so much shorter nowadays, and there's very few mainstream journalists here in the United States, and I guess probably in Europe or England, that do boots on the ground investigative journalism. Really dig into a story and try to make sure they get all their facts straight. And maybe interview both sides and try to figure out what's embellished. He said, she said stuff, and what's the real truth in between all that.
Yeah. It's difficult to do. It's difficult to do because you have to do it. You have to open your mind to possibilities that don't fit the narrative of the day, and that's it's never an easy thing to do. But for anybody, it's a hard thing to do, and for journalists whose time pressure is great, the deadlines are great. Sometimes, in a lot of cases, their income is reliant upon, let's say, a certain bend in the narrative. It's hard to do, which is why independent research, in my mind right now, has never been more valuable.
Or they're only paid per piece then, right? So, rather than focus on a long quality piece, right, and maybe winning an award in order to put food on the table, they have to crank out, bad piece after bad piece or mediocre piece after mediocre piece.
Yeah, look, that's the way of the world, unfortunately. It's the reality of it.
Yeah, I think there's just too much rent-seeking myopia going on throughout all levels of society, but that's probably a long discussion we can have another time.
Yeah.
In asking another question, I know you really enjoy financial history. I watched your speech from Toronto at the Cambridge House Conference. You made a lot of historical references. Based on what we see now in the world, the global economy, what do you notice is similar to different parts of history? Are we seeing elements of the right before the October 1929 crash? Are we seeing the 70s stagflation? What historical reference points are we seeing that are similar to back then now?
Well, the beauty of history, as was once said, is that history never repeats, but it rhymes. And so you can always find parallels with previous passages in history. And right now, last year was 100 years since World War I, and the parallels between 2014 and 1914 were staggering, which is a lot of what my presentation was about. In terms of this rising powers, fading dominant powers. And monetary pressure building up all around the world. The parallels are eerie. I mean, they really are. But then you can look at markets themselves, and you can find parallels, as you say, in the late 20s. If you want to look at the share of wealth in the US, for example, it's back at levels we saw in the Roaring 20s, and we all know what happened after that. There are parallels everywhere, and people have this tendency to say this time is different, but it never really is. It's not the outcomes that change. It's just the timeframes which occur for these things to play out. And sometimes a spanner will get thrown in, like Draghi's whatever it takes speech. Those three words, as I said, stop the EU falling apart. No one could have seen that those three words would do that, but they did. But the pressure's still there. So it's extended the timeline. But history is cyclical in nature. Markets are cyclical in nature. Human beings are cyclical in nature. And so anytime you have anything that's cyclical in nature, the implication is that it goes around in circles. And we see that. The business cycle is cyclical. We have booms, we have busts. And a lot of what's happened over the last couple of decades is the central banks have tried to suppress those natural cyclical market forces. And they've done it in order to stop one half of the business cycle, which is the downward half of the business cycle, at which point we get this creative destruction and bankruptcies and all the backburning that clears out the dead wood. The Fed in the 90s through Greenspan, their response became slamming rates down to zero in the response to every crisis to try and stave off this downward half of the business cycle. And that's fine, but through that period, the longer that goes on, the more you end up with this massive debt buildup. And in my presentation, I show the charts of what that looks like, and it's extraordinary. And when one look at that chart will tell you that it is completely unsustainable. But by the longer you sustain it, the bigger the disparity between real growth and credit gets. And so the fact that you are able to extend that is fine in the short term, and I'm sure everybody applauded the Fed in the 90s when they slammed rates to the floor, and a lot of people applaud the Fed now because they averted this crisis supposedly. Well, they didn't. They didn't avert anything. All they did was extend it and make the eventual crisis, when those market forces reassert themselves, and they will, because they are forces of nature. They've made that day infinitely more painful for a much larger number of people. So short-term, long-term, short-term great, long-term disastrous. But people don't. Election cycles are short-term. People's thinking is short-term, and then when the long-term actually happens, it's blamed on an event that happened in the short term. 2008 was blamed on the last couple of years of banks going crazy with securitization. It wasn't. It was the culmination of decades of credit expansion. So this difference between short-term thinking and long-term economic and natural cycles is something that you're never really going to reconcile, I'm afraid.
Yeah, I completely agree. I've spoken with people now, Graham. Maybe it's just our culture and, how people don't talk to each other on the phone or things like that anymore. People send text messages and emails and everything's, or people meet each other on apps and things like that. Everything's just fast now, faster paced. So it's like a long-term investment, 5, 10, 15, 20 years ago, that used to be, a couple years, a long-term investment. But a long-term investment now, if you went around talking with people, that might be 6 months or a year. So it just seems everyone's time frame has drastically been condensed.
Yes, look, it's a function of modern society. That's the reality of it. But society, like everything else, has changed over the years, and eventually has these reality checks where you understand that this has to change, because it's not natural. I mean that in the true sense of the word. And it feels like we are hovering around one of those inflection points right now. What it looks like, none of us really know. But I do know that a group of government employees in various countries with printing presses cannot, over the long term, suppress the forces of nature. It's impossible, I'm afraid.
Yeah, I completely agree. There's enormous ramifications for all levels of society suppressing the interest rates, because you can't have free markets in capitalism if you're going to drastically manipulate the interest rates. I mean, the cost of money, that allocates the capital throughout all society and the economy. So, it tells people whether or not they should be making investments or consuming or producing and different things like that. And, they've just distorted the signal so much with their market interventions. It's just very difficult to tell. And that's where I think the inflation-deflation debate fits in, because, a lot of people who argue like that, they're not from the same economic school. So they're not on the same page either in that regard.
Yeah.
Now, well, without having a long debate on inflation or deflation, do you think gold then, even if we do have some disinflation period or a period here where there's potentially more bank failures or Greece leaves the euro, do you think gold then is starting to put in a good bottom?
I think gold is something people should have owned over the last 10 years. It's when it became obvious what was going on here with the interest rate policy, money printing, etc. Gold should be a part of everybody's portfolio, in my opinion. People get caught up, again, it's the short-term, long-term thinking. People get caught up in the price fluctuations. And, oh, my God, it's gone from 13 to 1,300 to 1,200, and it's broken 1,200. At the end of the day, gold is not a short-term asset. It's not a trading asset. If you want to buy something at 1,200 that's going to go to 1,300, there are all kinds of shares that you can buy that will do that for you. That can get in and out of at the flick of a button. And creating something like the GLD, which gives people the ability to trade gold in and out, is fine, but it's going to destabilize the market, and it's going to make the price misrepresentative of the underlying reality, and that's very much where we are. And gold's an interesting asset, because unlike most others, it does have these two competing markets in the paper futures, which is the gold price as people understand it, and the physical metal, which trades at the price of gold. And the difference is subtle, but it's incredibly important to understand.
It's also not the same price.
No, and it won't be, because the price of gold is what it costs you to buy an ounce of gold. And that involves a lot more than going onto your E-Trade account and bringing up GLD and clicking buy. And so I think people who get caught up in the price of gold and say, well, anyone that bought gold at $1,300 has lost $100 on that. Well, yeah, but presumably that person hasn't allocated 100% of their wealth to gold. Presumably, elsewhere they've got stocks and bonds, and those stocks and bonds have gone up along with stock markets and bond markets all around the world. So essentially, what you've done if you had a 10% allocation to gold is you've taken a 1% hit to your portfolio, which is manageable. The point being, you have something that, in an environment where money can be created at will, an environment where the debt burden is clearly unsustainable, and an environment where there are any number of potential catalysts for severe dislocations in the markets, at that point, 90% of your portfolio is going to come under pressure. So having 10% of your portfolio that will perform and will protect your purchasing power and your wealth is incredibly important. I just don't understand the mindset that if you buy gold at 1,300 and it goes down to 1,200, you've lost money. Because realistically, unless you've allocated 100% of your portfolio to gold, which not just gold, anything, if you allocated 100% of your portfolio to equities, it's a foolish thing to do. Diversification is a very useful tool. So the gold argument tends to come down to, well, there's a whole bunch of people who say gold's going to go much higher, and it hasn't yet, so they're wrong. And on the other side of the trade, you've got a whole bunch of people saying, hey, look, the reasons for owning gold, and look, for full disclosure, I'm one of this latter group. The reasons for owning gold have never been stronger, but yeah, you know what? The price has come off a bit. But the price, people benchmark the performance of gold from 1900, and they say, well, it was at 1900 in 2011, and now it is at 1200. That's a $700 fall. Well, yeah, but before the 1900 print, it went from 250 to 1900, pretty much in a straight line. The difference between whether this thing was a correction or a collapse, the move from 1900 to 1200, depends on your entry price. If you bought gold at $250, this is a correction, and it's a chance to average your position lower. If you bought it at 1900, yeah, it sure as hell feels like a collapse. But if you allocated 10% of your portfolio to gold at $1,900, and you're down here, you've taken a 3% hit to your overall portfolio, which the moves in the S&P and the other things that you're likely allocated to will have more than mitigated. So the gold market is a fascinating place. The opacity lends itself to all kinds of theories and all kinds of guesswork. But ultimately, it's about owning an insurance policy. Some people want it as an inflation hedge. Some people want it as a trading vehicle. Personally, I want it as an insurance policy. And right now, I want it as a currency because, as somebody said to me recently, which I thought was the perfect summation of what's going on, he said, in a currency war, which is clearly what we're in at the moment, gold is the only currency that can't fight back. And that's why I want to own it. You can't print it.
That's a great point about the gold being in the currency war, and even Alan Greenspan said that gold is the most superior currency out of all the currencies or money. So, although Greenspan, I consider him a traitor, but anyway, though, because he actually read Ayn Rand and knew Austrian School Economics. His article on gold and economic freedom, I think, was one of the best articles ever written about it.
Yeah, I don't disagree. It's interesting to see how now once he's out of the policy-making sphere, he seems to have found his religion again, and I think that's telling for people that don't understand gold. You can suspend your belief in it, although I doubt he ever suspended his belief, but his job dictated that he couldn't be an advocate of gold, obviously. But at the end
or he had to manipulate it, yeah.
But at the end of the day, when normal market forces can assert themselves, he's not in the employ of the government. Well, guess what happens? He comes out and says that gold is the best currency in the world. Gold hasn't changed in the interim. It's just his public expression of that has changed. Gold was the best currency back when he was espousing it in the 60s. It's the best currency now. It didn't change. It's just that the fact that Greenspan couldn't say that out loud for 20 odd years.
Yeah, I completely agree. He was getting paid to sell give out those gold swaps and gold leases and all those different types of things, and let the Wall Street banks build the over-the-counter derivatives market and look the other way. My final question for you, Grant, involves gold as well. We've seen Cruz Jansen and Bullion Stars numbers about the Shanghai Gold Exchange. I think China's been buying more than 100% of annual global gold mining supply in 2013, 2014, and they're on pace to do it again in 2015. How much longer can China, and then that's not even counting, the demand from Russia and India and Asia, how much longer can these countries buy more than 100% of the annual gold mining supply, and the paper price just it either goes down or doesn't do anything?
Well, this is the crux of the whole thing. I mean, we don't know. Again, it's another when question, and nobody knows. Right? We can all make educated guess, and Kuz does phenomenal work. I mean, his website bullionstar.com is somewhere everybody should have bookmarked that even remotely cares about gold, because Kuz is fast becoming a real superstar in that space. But when you look at the numbers, and here again we get back to this physical metal paper contract dichotomy, the central banks, particularly China, you're referring to in the question, they're not buying paper contracts, they're buying physical metal. And the reason for that is simple. No matter how long this can go on, the one answer I can give you with definitive assurance is it can't go on forever. And so the Chinese government, the PBOC, the PLA, that they will be buying as much gold as they can. And while the price stays down here, the paper price stays down here, that only helps them. But at some point, because it is a finite asset, it's not going to be available. And if they want to buy more, if they don't have enough at that point, they will bid the price up. And once the price starts going up, people will want to buy more. And when they want to buy more and they realize that all the supply is gone, the price goes up a lot. I mean, it's really simple supply and demand. But the supply of physical gold is limited. The supply of paper contracts is unlimited. As we've seen, it's the same with currency. Gold is physical currency. Dollars are paper currency. Physical gold is a physical metal. Futures contracts are a paper currency. The split is the same. And yes, you can print unlimited amounts of dollars up to a point where people don't have faith in them anymore, and that's when you get a Weimar Germany. Same way you can print paper certificates for gold, right up until the point where people don't have faith in them anymore. But in the case of gold, when you reach that point where you go, oh my God, I need physical metal, it's too late. You can't buy it when you need it. You need to buy it when you can buy it, and that's exactly what the Chinese and the Russians and the Indians and the Turks and the Philippines and the Thais, they're all doing, because they realize that it's something that ultimately, if we have a dislocation, can't be printed, and therefore overnight becomes infinitely more valuable.
Yeah, I completely agree. They're thinking more long term. They're not thinking like Wall Street or the trend trading hedge fund manager, who has a month or a couple months or a quarter, to improve his returns. They're thinking, about the potential next global financial system, about protecting their currency from currency wars and all these other things.
Well, people who look at gold should try to get themselves in the mindset of the central banks, because these are the biggest players in the gold market. They always have been. And if you look back over, from the late 1960s through to 2008, central banks were relentless sellers of gold. This helped keep the price down. And they sold gold. You just have to pull up a chart of central bank gold reserves, and it fell precipitously for 30-odd years as they sold it. In 2008, they turned around and started buying it. Now, if you have a commodity and you withdraw the biggest supply, then the price is inclined to go higher. If you go the extra mile and you turn the biggest supplier of the commodity into the biggest buyer of the commodity, you've got the potential for much higher prices. Now, if you're the Chinese central bank and you've been buying gold for the last however many years, and you're buying as much of it as you can get, do you think they care that the price has gone from 1,300 to 1,200? Of course they don't. Do they care that it went from 1,900 to 1,100? No.
They probably want a lower price, right? Because they can buy more gold, right?
but they have, the advantage they have is that they know, the Chinese know, that if tomorrow they came out and said, well, you know what, I know our official gold holdings are 1,054 tons, we're just going to update you. It's actually 10,000 tons now, which is a perfectly feasible number based on the flow of physical gold around the world in the last few years. The price of gold will instantly go higher, and they're going to get back any paper losses they may have made. So it doesn't matter to them. They don't care that the price is going down. It makes no difference to them at all. And they're the biggest buyers of the commodity on the planet, and they're completely price insensitive. It's about how much of it you own. And so for investors on a smaller scale, the thinking should be the same. It's not about the price, although obviously in the short term, when the price gets extended, you don't really want to jump in and buy it when it's gone from 1,500 to 1,900 like it did. But now, obviously, you have to be sensible about it. But it shouldn't be your primary concern. It should be, okay, in my portfolio, what percentage of it should I, as a prudent measure, allocate to gold? And a lot of people will tell you it's zero. I happen to think those people are wrong. Some people agree with me, some people agree with the other side. But, we can only give our own opinions. And mine is that over the course of the entire history of monetary finance, when you've needed gold, it's done what it's needed to do for you. And there are times when you don't need it. There are times when you really don't need to own your gold. And right after World War II was essentially one of those times. You didn't need gold because we had tremendous growth, government balance sheets were in order, and it wasn't a dangerous thing to not have an allocation of precious metals. Now, I think it's an incredibly dangerous thing to not have an allocation of precious metals.
Yeah, I completely agree. That's great analysis. In wrapping up this interview, Grant, we've almost gone for an hour. I just enjoyed having a great conversation with you about the markets. You have great experience, and you love history like I do. I was a history major undergraduate of college, and I like reading about financial history, whether that's the Weimar Republic or other types of things. Please tell our listeners more about your newsletter and more about your new venture, your company, Real Vision TV, that you founded.
Sure. My newsletter, Things That Make You Go Hmmm, you can check out the website, which is www.ttmygh.com. I publish every couple of weeks, and it's a macro look at events that drills down into some of the more curious and slightly less mainstream things that are happening and tries to kind of get a sense of what's really going on under the surface. Real Vision Television is an initiative that I started with my partner, Raoul Powell, who's a long-time investor, very well-known guy in investment circles. And it's an online, on-demand TV station, essentially financial Netflix. And we sit down for extended interviews with really the brightest minds in finance. And we give them the ability to sit and talk in a way they never get a chance to do on the likes of CNBC. We give them time. We give them the freedom to say whatever they want and what's really on their mind. And what we found is once you give people with really great financial insight that ability to do that, the result is phenomenal. And you can take a look at that. There are trial videos up on the site, which is www.realvisiontv.com. And we're very, very proud of it.
Yeah, I haven't seen any of the videos yet, but I saw you did get Kyle Bass, and they were discussing that before. I'm a big fan of Kyle Bass's work. I think he's a really awesome money manager and outside-the-box thinker.
He is. He's an awesome money manager, an incredibly smart thinker, and a really nice guy. And the beauty of our interview with him was we got the chance to sit down for an hour. And that's a free video on the site. Anybody can watch that and get the kind of insight from Kyle that you never get access to in a 90-second soundbite on CNBC. So. But it's not just Kyle. We've had Bill Fleckenstein, and we've had Ben Hunt, and we've had a whole slew of people, and we've got a lineup coming up of really impressive financial minds that people are going to get a real kick out of hearing from.
Sounds very educational for people who actually want to learn something, instead of the back and forth stuff on CNBC or Bloomberg where, someone gets, they may have spent 5 hours getting to the TV studio and sitting in makeup or sitting like at a satellite TV station to get 2 minutes on TV.
Yeah, exactly. That's what we're trying to get away from.
Yeah, I'm fed up with that too. I try to tell when my parents watch financial television, when I see them and I see that they have that on, I try to tell them not to watch it because it's just bad entertainment. You're not actually going to learn really anything valuable.
Sadly, you're right.
Yeah, well, I mean, I think it's really smart what you're trying to do to go in depth because I think we need to improve people's financial education so the Keynesian central planners don't get away with this for that much longer.
Well, as we've said, all things come to an end, and that will too. It's just a question of when. So let's all try and prepare ourselves better for it when it happens.
Yeah, I completely agree. The first thing people should spend their money on rather than get investments is educate themselves properly. And then, after that, then when they're feeling more comfortable, then they should make smarter investment decisions. I'm 100% all for that.
That's very sound advice, Jason.
Now, thank you again for your time, Grant. I really enjoyed the discussion, and hopefully we